Foreign exchange exposure and risk management, CA Final SFM Chapter 9 full. In this class, we are going to investigate foreign exchange exposure and risk management in a detailed way. By the end of the session, you would be able to get a grasp on the following: how is exchange rate between different currencies determined? What is foreign currency market? What are the risk exposure? How can someone hedge such risk? What are the hedging instruments available? So, why understanding foreign exchange market is important? With more deregulated markets around the world, the flow of capital and revenue among cross borders have increased significantly, be it in the form of foreign investment, exports, and imports. A businessman coming across different currencies while dealing in day to day international transaction has become more common. This gave birth to a wide range of products that mitigate the risk involved while dealing with different currencies. So, having an understanding about these products is like having knowledge about new tools so that you can do your work better. So, as someone who wants to excel in financial management, it is especially important to know about foreign exchange market and related financial products. The sole idea here is to position yourself better in a risky global cross-border transaction. These days, new money transfer methods are being invented and new definitions of money are coming into the market. However, nearly all the major transactions internationally still depend on banks. So, in order to sort the swift transfer of payments between countries, banks use different settlement methods to make this happen. One of the tools they use for this is international money transfers are accounts such as Nostro, Vostro, and Loro. And these are Italian words for ours, yours, and their. To understand this, let's consider two countries, India and UK. And India, there is a bank called SBA, and in UK, there's one bank called Berkeley. So we are in India. So an Nostro account in this example will be if State Bank of India opens a current account with Berkeley in UK noted in pound. So, or we can say that it has our account with you. And a Vostro account in this example will be Barclays Bank's account in India noted in rupees. Or we can say it as your account with us. If we look a little more closely, we can say that Barclays Bank's account of SBA they have with them is a Vostro for them. Now that the third one is if another bank in India, like say HDFC Bank or ICICI, if they are trying to use SBI's Nostro account with Berkeley, then they'll be noting the same account as Loro in this scenario. Exchange position and cash position. In an exchange position, transaction whether taken place or not is counted. In cash position, the actual transactions are depicted. Now let's look a little more into exchange position. As we said, the bank has to maintain records for both ready and forward currency. That is, it doesn't matter if the transaction took place or not. The commitment is enough to record the transaction. Now let's look into two scenarios in Nostro account. Oversold. This is also called short, where here sales exceed purchases. Overbought. It is also called long. Here purchase exceeds sales. Generally, both short or long is often referred as open position, and if they are both equal, that is, if sales and purchases are equal, it's called a square. And based on the open position, the bank has to sell out by forwards or sell out by sports. This process of risk mitigation is called cover position. American terms and European terms in exchange rates. When dollar is quoted as per one unit of foreign currency, it is American terms. When foreign currency is quoted as per one unit of dollar, is called European terms. Commonly, we see ET more often than AT. Direct quote and indirect quote. This will be if it's a direct quote, we are trying to explain home currency per unit of one foreign currency. That will be direct quote. And if you are trying to explain foreign currency per unit of home currency, it is indirect code. There are certain implications to this, but it's very generic, and these indirect and direct codes are reciprocal of each other. So, a lower forex rate in direct code implies that the value of domestic currency is appreciating. Conversely, if the domestic currency depreciates, it implies that a higher amount will be needed to exchange for one unit of foreign currency.